You had a wonderful weekend, and the weather treated you well at this beginning of the summer. So today we have a guest speaker. He's one of the most creative guys I know in the industry, especially on the life side, is Jeff Thompson from ECA. And he's going to share a concept that I had not heard about before, and he actually discovered it. And this guy is great because he's actually discovered many different niche marketing or unusual ways and creative ways to use life products, and he's made a ton of money for advisors because of that. So we're lucky to have him on the call today. So Jeff, I'm excited to hear what you have to say.
Thanks, Mike. Yeah, I would say this is a pretty unique concept. This is something that in searching for something unique for one of my advisors, because he had clients that were really asking for ways to purchase life insurance with large amounts of qualified money rather than writing a check for it. And also was looking for a way to get a tax advantage at the same time. And I thought, well, that's a pretty tough challenge. So I started doing some research and found this concept. It is today the strategy that he does probably 50% of his business from, and he's our #1 life producer at ECA. And also, you know, $1 million round table, top of the table guy, one of the top 1% in the world for life insurance sales. So this is a very, very hot concept with business owners. So we can just dive in. So I'm going to just kind of cover a couple of key points here. Oh, get my PowerPoint working. So let's just talk about what this concept is first off. We call it distribution solution because what this really is a strategy for tax efficiency upon distribution of qualified assets.
So hey Jeff, can you hold on a second?
Yep.
I get one person saying no voice. Everybody else hearing the hearing? Can I get some yeses if you're hearing Jeff just fine? Okay, so but I don't know what the problem is. Everybody else is hearing Jeff fine. Sorry about that, Jeff.
Okay, that's all right. Did you want to make mention of if you're not seeing the full screen, you might want to go up into the go-to. I don't know if it was go-to webinar or.
Yeah, Missy, can you tell them what to do in case they're getting a small screen there?
Yep, if you're just seeing a small screen, there should be an option like where you would normally maximize your screen window, that you can just view it in full screen mode. Just click on that as an option, and that will make your screen bigger.
All right, thanks. Okay, so let's start off with, this is a legal way to get tax relief on distributions from qualified plan assets. And this is designed specifically for business owners. There are also business owners that have to still have an active business earning some income from that practice or that business. I like to say this is an IRS compliant program, and it allows you to buy IUL inside of a qualified plan. Ultimately, at the end of this whole strategy, we're going to have an individually owned life insurance policy that's non-qualified and can produce a tax-free income. In the process, though, we're going to get a nice big tax benefit from it. I think this is an important piece. It does make use of existing IRS code. A lot of people are concerned about life insurance strategies that give a specific tax benefit that might be based on a private letter ruling. It might be a little bit sketchy as to whether or not it applies to their situation. This is straight up plain tax code, so there's nothing really edgy about it. It's just not well known, and I think it really would have required somebody to understand not only how this particular product that we use in this strategy works, but also be able to combine how that interacts with the tax code. So this concept was actually developed by an advanced markets attorney at a carrier, which we'll talk about later. Already covered that. So this is really the big kicker. I think this is where a lot of the appeal of the strategy comes in, and it really is a tax play. If you've got clients that are business owners with sizable qualified plan assets, more often than not, they're not going to really have much of a strategy or an approach to minimize their tax liability upon distributing those assets. So they're going to get hit with whatever their marginal tax rate is on the distribution of those assets. this strategy gives us a way to save roughly 35 to 40% on qualified plan distributions. And of course, the way we structure this is it's a max funded policy inside the qualified plan. So ultimately, upon distribution from that qualified plan, we're going to be able to get that tax-free income using loans. The particular product that we use also has a package of living benefits. We'll get into that a little bit more later, but it basically has critical and chronic illness, critical accident, and terminal illness accelerated benefit riders built in. Because this product is an IUL, it's obviously going to have a lot of the benefits of an indexed annuity, reduces exposure to stock market volatility, gives you a sizable amount of upside with cap rates on IUL being quite a bit higher than on indexed annuities. And that obviously gives us some potential for outpacing inflation. So where this works well is it allows us to use those existing qualified plan assets, and it can be from anywhere. So SEP, simple, 401k, IRA, defined benefit plan. We can pool all those assets into this particular design. So whatever they've got in any type of qualified vehicle, we can combine those into this particular plan. Just a quick note on defined benefit plans. One of the unique ways that we're actually using this is, let's say some business owners haven't really accumulated much. They're really just counting on their business to be their primary retirement. That's their retirement savings plan when they sell their business. But if they have good cash flow, they may consider doing a defined benefit plan. And depending on their age, they might be able to make sizable contributions far in excess of what you might do in a typical 401k. And so it's a way for us to load up lots of cash in one of these strategies. Now, we may not be able to use all those dollars immediately, but it does give us a current year tax benefit that can be quite sizable. We can still use a very large portion of those dollars in the first year, and then all of them after a couple of years. And then obviously we get a tax benefit on the other end as well. So using a defined benefit plan, the calculation basically is based off of what the maximum income they want to have. And so the IRS right now allows up to $215,000 a year. So whatever it would take in order to produce that at retirement age. So like I said, the older they are, obviously they don't have as much time to fund the defined benefit plan. They can put some pretty sizable chunks of dollars into this and get a tax benefit in the current year. So that's just a creative way we can use this. But who's this for? So let's just narrow that box down and define exactly who our ideal client is for this type of strategy. It's business owners, I already mentioned that expect to have earned income for a period of 5 years. Now, they don't have to have earned income for the previous 5 years. And in fact, even the business that they own is pretty flexible. The big thing is that the IRS is going to want to see earned income. So they could have an Amway business. They could have a business, building birdhouses and selling them at the flea market. I mean, as long as they have earned income, it doesn't have to be enough earned income to equal the amount that we're funding this strategy with, because we're using existing qualified assets in most cases, although, in some cases we're able to use those new contributions as well. Age-wise, this works best between 55 and 70, although we've done younger and older cases, and it can work great. We may lose some of the benefit if they are under 55, but it can still work great even over 70. We actually just recently did one that was someone in his early 70s, and it worked great. He was actually concerned about not having to take RMD, so that's another unique characteristic of the strategy, is that we can eliminate, of course, their RMD and give them a lot more control over their taxes and their income. Now, ideally, they should probably have qualified plan assets of at least 150,000. Most of these cases, I'll tell you, most of these have been very large. I would say the average commission on these cases, by the way, has probably been somewhere upwards of $100,000, so they're very sizable. One of the neat benefits of this strategy is when you show it to somebody, we've actually had, I would say, close to 50% of the time when a client sees this for the first time, they often tell you about other qualified accounts that they forgot about. So we had a case recently where a lady had disclosed $400,000 of qualified assets. We did a case design, showed this plan, and all of a sudden she found that she had another $400,000 that she forgot about in IRAs elsewhere. So maybe a neat way to get them to uncover or disclose all of their assets if they already haven't. So what I would say as far as case size goes, it's not uncommon to see cases of upwards of $1 million premium going in over a 5-year period. So 150 is at the small end, just to put it into perspective, but that's about the minimum just because there are some expenses related to this and how we set it up that we wouldn't want to go a whole lot smaller than that. And of course, they have to be healthy enough to qualify for life insurance. In this case, they can actually insure a spouse as well, or instead of themselves. So we can use these qualified dollars to actually insure the spouse if they're not healthy enough, or if they want to do coverage on both inside that same qualified plan, we can use one person's qualified dollars to insure both. And a lot of times they want to do that just because they like the living benefits package, which I briefly covered. So why would somebody want to do this? What's the market opportunity look like for this? Well, obviously the big issue, like I mentioned, is the tax liability that they're facing on these qualified dollars. And most lack any kind of meaningful strategy to reduce their tax liability on those tax deferred dollars. We know that depending on what their tax bracket is, obviously they could be facing upwards of 40% of those retirement dollars going to someone else.
Hey, Jeff, question.
Sure.
So what if they have a sizable 401k, sizable retirement accounts, but they're employed? Could they start a side business and do this to, because you can't do this as an employee. You need to be a business owner. Is that correct, first of all?
Yep. Do you need to be a business owner? And actually, that's a great question. I was sort of alluding to that, but yeah, we actually have had cases where, let's say they own rental real estate, but they're only taking rental income right now. They might actually set it up so that they take an income for property management. So now they have earned income.
So whether that 401k came from being a business owner or not, they could use this idea to lower their tax, or they could use this idea with the 401k that wasn't necessarily built, or defined benefit plan that wasn't necessarily built from them being a business owner.
Right. Yeah, this actually could be a government pension that, as long as they can get a lump sum from it, and we have a business that's going to show earned income. That's really the key. So we can be creative there, obviously. It doesn't have to be a full-time business by any means, as long as we have earned income there.
Thank you.
So yeah, yep, you're welcome. So many of you have probably already seen statistics like this, but there's a total of $24 trillion in total U.S. retirement assets. So obviously the market opportunity is sizable. I'm sure the federal government is looking at that juicy steak and waiting for those tax revenues to come in. They'll be a little bit disappointed, though, if you guys get out there and sell a lot of these and we mention that number. So, let me just go back here quick. Obviously, this is really any of these assets here. So any of the categories that you see there, we can actually draw on those assets. We've had money come from really virtually every type of qualified plan. So defined benefit plans, IRAs, SEPs, simples, 401k plans, annuities, IRA annuities, not non-qualified annuities, just IRA annuities. This is just another breakdown, but obviously there's a lot of money that we can be accessing and give somebody a really compelling alternative to maybe some boring, underperforming assets that are within a 401k plan. As most of you know, most of those options are pretty milquetoast at best, and most clients aren't even really all that well informed on what they have in those 401k plans. So giving them something that's really kind of a neat alternative with big tax benefits is a pretty easy sale. I'd say our top producer, I'll give you a quote from him. He says that this is the easiest sale he ever makes. So it's not that it's simple necessarily, but it is easy in terms of the clients really liking the value proposition that we're giving them. So obviously the government tells you when you have to take your money. If you take it early, they don't like that and give you a 10% penalty. If you take it at the right time that they specify, then you're okay. Well, sort of. You know, you're still going to have to pay quite a bit of taxes on it. And then if you wait and take it late, or don't take it when you're supposed to take it, obviously there's a sizable penalty for not taking it then. So clearly they want their money at some point. And we're going to give the client an alternative to get out of this scenario on a tax-favored basis. So one of the clients that we actually worked with and did a very sizable case with actually called this, rather than the distribution solution, which is what we call it, he called it the RMD solution, because that was what obviously was on his mind. He didn't want to take those RMDs. He wanted more control. And of course, we give them a way to leverage these assets as well. So a lot of people ask, well, you know, why wouldn't we just do a Roth conversion? Well, I mean, as it turns out, there's a lot of reasons why, but most often there isn't really any tax benefit to this. But you know, that'll depend, of course, on whether or not somebody's tax bracket is higher or lower in the future. And then if their income tax might also have some other taxes in the future which we don't know about. Of course, that whole future tax liability is a huge question in general, because you know, the government can change tax policy in any administration in any given year. So just because taxes are what they are today, of course, has zero bearing on what taxes might be in the future. And of course, if the client wants to delay their distributions beyond 70.5 or maybe not take them at all, this is a nice alternative if they wanted to do a Roth conversion. We actually do a case study, and I'll offer up right now that we do have a sample case study that compares this to a Roth IRA, as well as to just leaving the money in a qualified plan and taking distributions from it, and what the impact is. This is typically an income strategy, so that said, there's a little bit of time to make this work, annuity strategy, so there's a funding period, a period that we have to let it grow for a little bit, and then we can take income. That's normally about a 10-year time frame. So where this might fit in, depending on the age of your client, it might be, you know, the last stage of an income ladder. It's used in a variety of different ways, but like I said, normally it is an income strategy, although it doesn't have to be. We've done these also as a death benefit focus that preserves and grows the cash. But the goal is really to just pass the dollars on in a more tax efficient way. So this is sort of how the sausage is made. This is a diagram. I'll just quickly walk you through it. Essentially, we're taking an IRA or 401k or whatever that might be, putting that into a solo 401k in many cases if it's a closely held business, or it could be just a regular 401k. inside that, we purchase a life insurance policy where we make 5 premium payments. So this is a 5-pay policy structured to be a max non-mech inside this profit sharing plan, which is typically, like I said, a 401k or solo 401k. When we distribute the policy, the IRS tells us how we're going to value that, and this is a very conservative approach to valuation so that we don't ever run into any audit risk with the IRS. We use their calculation instead of some other number. We determine what the fair market value of that policy is, and that is where we get the tax savings. And then, of course, that policy at that point on, from that point on, is now tax-free. The client would have to pay taxes, of course, at the time that we distribute the policy, so it's all done in 1 year. And one of the questions I frequently get is, because it's distributed in 1 year, how does that affect their tax a different tax strategy, where we maybe take money out over time, hoping to be in a lower tax bracket and save money that way. Well, you have to run the numbers. I mean, sometimes those scenarios might work better. More often than not, we find that this actually works better because the tax benefits are actually ongoing beyond just that distribution, where we gain that 35 to 40% tax savings. We actually continue to get tax savings because now we have a vehicle that can produce a tax-free income, which might potentially eliminate or reduce taxes on Social Securities. And of course, there are other benefits in terms of passing that asset on income tax-free with the death benefits, a leveraged death benefit. So this may not make a whole lot of sense to you right now, but this is kind of the reference diagram. If you have a case, that'll give you an idea of how this works. Just give you an example here with some numbers. So this is a typical case. Like I said, they're frequently over $1 million. So $1 million IRA, we're assuming a 40% tax rate. Now that may vary depending on your state, between state and federal, what bracket you're at, but we'll use that number for this example. If they were to take the distribution as a lump sum, that's a $400,000 distribution. $400,000 tax on that distribution. Our alternative, this distribution solution, has a market value at distribution of $626,000 and taxes of $250,000. So sizable tax savings. In this case, it calculates up to 37.4%, or $149,600 of taxes saved. So I'm sure probably a lot of you are wondering, how does this strategy work to save taxes? Well, if you're looking at that PERC valuation there, that PERC market valuation, that's based on the net cash value inside the policy. So this particular product is designed to front load the expenses on the policy during the first 5 years. It's a 5-year surrender charge IUL. Typically in the industry, they're 10 to 15-year surrender charges. They're just taking those same charges and compressing them. So during the first 5 years of this policy, it literally is the most expensive IUL on the market. Now that doesn't sound very exciting, if you're trying to a client, like, yeah, I've got the most expensive IUL on the market. But after that 5 years, it's actually the cheapest IUL on the market. So it then performs quite a bit better. And it's designed to do that. So it's designed really to give you this tax benefit by compressing those fees in the first 5 years, by having a.
Okay, can you stop? Can you stop a second, Jeff? Anybody else? I got another audio problem. Is everybody else hearing him okay? Can I get some yeses? Okay, so just one person. Okay, good. Thanks, Jeff.
Okay, good. So so a lot of the key to this is really having the right product. Now, have we done some research to find if there are a lot of products that do this? And as it turns out, there really is only one product that we've found that even works. So we're still looking to see if there's anything else, so that you might have a second choice at least. But the product that we have has performed quite well. It's a very competitive product with unique characteristics, obviously this being one of them, that gives us a substantial tax benefit.
And guys, can I ask you guys a question? Why is it good if only one product does this? right now? I know that we like more choices, but there's advantages and disadvantages to everything. Why is it good that only one product does this right now? We have it. That's one reason. No one else has it. Yeah, I mean, they have it, but they don't know about it. So if everybody was doing this, it would be a technique that everybody would know about. So again, kudos to Jeff for finding this, and it's also not a bad thing to have, and it's a good company, so not a bad thing to have only one company doing. Okay, sorry.
Yeah, and we actually like that too because it does give you a competitive advantage. I mean, even if they knew the carrier, they probably don't know how to implement this correctly, and they wouldn't know how to put it all together, even if a client brought it back to them. That just isn't likely to happen. So we like it for that reason. This is just some disclosure stuff, but we don't need to get into that. This just gets into a little bit about the perk value, so you can see the basis for how the tax savings occur. Some of you guys might want to look that up, so in the event that you do, this is where you look. So as I mentioned, the policy itself obviously gives us quite a few tax advantages. One of those is a tax-free death benefit from the inception of the policy. So this policy owned inside of a qualified plan, let's say they fund it with $1 million, gives us a $3 million death benefit. The net amount at risk or pure insurance portion of this policy, assuming it's a $3 million death benefit, would be income tax free. The $1 million, while it's still funding the policy and the policy has not yet been distributed from the plan, would be subject to ordinary income tax, but they still get a nice $2 million bump, all tax free, which I'm sure can cover some of those taxes. So there's also a possibility, if they need to, that we can also make the death benefit estate tax free. Just depends on their situation, and putting it into a trust if we need to. A slat trust is probably the most common that we might use. And of course, like I said, we don't calculate, and even in the case study that we do, we don't calculate the ongoing tax benefits that accrue from being able to withdraw income tax free from the policy using loans. That's substantial. I mean, it may even be very close to what the initial tax benefit is upon distribution. So that's something we might modify down the road, but it's a little tougher to put a case together because it's so dependent on the individual's tax circumstances, and so we don't generally do that. But it is something that I think is absolutely a very valuable portion of this strategy. And
so what you're saying is the tax benefits are much larger than what we're even showing them, based on the ongoing tax they won't have to pay.
Yep, exactly. So I mean, if it keeps them down, a margin, one bracket in the tax code, that may be, who knows, tens of thousands of dollars over the course of the distribution. So, and it may impact their other income, their Social Security, their Medicare premiums.
Mm-hmm.
So these living benefit riders on this product, there's no cost for those. They basically pay at the time of claim. So essentially what happens is there's a discount factor applied to the face amount of the policy, and then they determine what the net benefit is to them after that. So there's no cost while it's not being used. So if they don't use it, it doesn't cost them anything. And the benefits include chronic illness, so essentially a type of long-term care coverage, critical illness, so that would be heart attack, stroke, cancer, variety of other critical illnesses. There is actually a lifetime income rider on this, so if you want to convert your income, rather than using an index type loan or a participating loan, they can annuitize this and have a guaranteed income for life, whatever their cash value is at that time. And that, of course, can be any type of payout, just like in an annuity. I don't think we need to go too much more into this, but this is an attractive part of the package. So a lot of the folks that happen to be business owners might already find this to be an appealing value proposition, because it seems like a package of benefits that they might buy for themselves if they haven't already done that. So just skip a little bit. Here's an example of what those benefits might look like. So if somebody has the maximum, they might have a terminal illness benefit of 1.5 million. I believe that's the maximum that the policy will pay out. Chronic illness, $30,000 a month. Critical illness could pay out up to $1 million. That varies depending on the severity and the specific critical illness. There's also a similar critical injury benefit as well. So here's this is a sample case study. I just wanted to show you what this looks like. If you look at the premiums paid column, you'll see we're funding this with $1 million, so $200,000 a year over a 5-year period. That next column over is the IUL's cash surrender value each year. And then we actually, in most cases, and this varies depending on the client, but in many cases we'll design this where we set aside a portion of those qualified assets to pay the taxes upon distribution so that they don't have to come up with assets outside of the qualified plan. We already know the IRS already owns a chunk of this, so we might as well set aside a portion of that and not fund the whole strategy using the dollars that we have to give up anyways. And of course, we're going to be giving up a little bit less. So that's what that excess qualified plan balance is there. And then we're showing income starting in year 11. In this case, it calculates out to $77,436 to age 100. And that income tax due column, that's showing the taxes due upon distribution of the policy. And then the net income due that's actually that excess qualified plan balance. Excuse me, that net income is the amount that we have available to help cover some of the taxes. So it's, in this scenario, they didn't do enough to cover the whole thing. Death benefit column, obviously you see that we start off with a much larger death benefit. A lot of that is just TEFRA, DEFRA, and TAMRA, making sure that we're able to max fund this and have it remain a non-modified endowment contract. So that just allows us to preserve the tax benefits when we finally take the policy out of the qualified plan. It still stays tax-free on access to the cash values. And so initially they get a very sizable benefit. We're going to reduce that death benefit over time by taking income. So if you haven't sold IUL before, what happens is you have a proportional reduction in cash value death benefit as you take income year after year. Now they may hit a sweet spot where it actually starts to grow again, and that's a little bit hard to explain, but I'll kind of give it my best shot here. What happens is the money is still actually in the policy. It never really leaves the policy. You're getting a loan from the carrier's general fund. And so as your policy values continue to grow, if you're getting a positive spread or a positive arbitrage of 1% on your accumulated cash inside that plan, you actually may be earning much more interest than you're taking out in income at some future point in time. So obviously, at this case, it gets to be fairly late. You know, at age 95, it starts to, well, actually at age 85, it starts to head back up.
And you're using a 5% interest rate on this?
We are, yeah.
Okay.
Yep. Yeah, so it's a conservative assumption. And actually, during the funding period, we use a fixed interest bucket. So we're not even allocated to one of the indexes during that time. The reason for that is that we want to minimize the tax liability, and having index-linked growth would probably push that up a bit. So we just have a fixed strategy during that first 5 years, and then we allocate to the index after that. So it's a very conservative design. And here we're just comparing apples to apples, showing an IRA with the same balance, showing the same 5% growth and same tax rate, and then matching the income up. Now, obviously, it takes a bigger withdrawal from the IRA to net the same amount that we get from the life insurance. So this just shows that essentially we run out about 15 years, 20 years early in this case. So And the other end of this is, the death benefit that the client gets is much smaller, even their after-tax benefits if we flip back here.
And could you address why you have this up too, Jeff? We had a question about the IRS, the perk value at year 5. Is that shown on this chart or not?
Yeah, it's actually the income that we show at the end there. So in the income column here, where it says 747, 443, that's actually the perk value.
Okay, got it.
Yep. So obviously you can see it can, now it doesn't always, and I like to preface that, this doesn't always work for everyone. So, this isn't a cookie cutter sale. We have to run a case design, make sure it actually works and makes sense for them. There are things we can do with this case design, though, to make it more attractive. If for some reason it doesn't work with our standard assumptions, there's some things we can do, like a term blend, to make it look very attractive in almost every case. So it just depends on the scenario, though. So here, obviously, it beats the tar out of an IRA and just leaving your money in that qualified plan.
Do you have what kind of person would this not work for? What would somebody say, this probably ain't going to work for this guy, just so they wouldn't bother, going down this road? Do you know, or is there characteristics?
I think it tends to be usually somebody that's older and needed the income from this plan earlier.
Earlier.
So, like I said,
can't wait for 10 years.
Okay. Right. So if they have sufficient assets that are non-qualified or other resources, maybe they have, they only want to use a chunk of it. We actually did a case recently where the guy had $10 million in his IRA, and decided to use $3 million for this. So we may get enough. He may do more of it later, but he ended up using just $3 million out of his 10. So a pretty nice case.
Cool. Yeah, that's very nice. And what's a commission? Are you going to talk about commission? Just to give guys who aren't familiar with life why this is a good sale to have.
Yeah, I would say comp-wise, we're probably somewhere between 30% to 300% more than what you might make on an annuity. So varies obviously on the case design and the age of the client.
Okay.
But I would say, in the last year and a half or two, we've averaged well over 100. It's over $100,000 in commission per case typically. So they're
perfect.
They're very nice
cool.
cases, and they would certainly pay more than a comparable annuity.
Right.
And sometimes a lot more. I would say more often than not, it's double or triple.
Perfect. Okay.
And puts the client in a very good position as well. So here we compare that to a Roth conversion. Of course, the Roth, you're not getting any tax benefit upon distribution, so you're going to pay the whole 486,203 for conversion, and also run out pretty early upon taking income. So both happen to run out in this scenario. It looks like around age 80. And this also has the same issues here. Net death benefit isn't as attractive. So like I said, we have a detailed spreadsheet and case study for anybody that's interested. Probably the best thing to do is reach out to Jerry on the 5Q team, and he can get a copy of this to you. And it's actually a detailed spreadsheet with tabs that do a comparison, so you can look at it in a little bit more depth. We also have a summary. If you happen to have someone you're thinking of right now that might be a good fit to see if this case this strategy would work for them, we have a fact-finding sheet to request a case design as well, so we can get that out to you too. This is just another way to show it, but it has a little bit more visual impact, as we're looking at the net insurance death benefit. And these two big bars here are the insurance. So insurance total after-tax benefits are this gold bar, and then the net insurance death benefit comparing to the qualified money after-tax benefits and the total after-tax benefits of the Roth, so at different ages. Makes it easier for the client to understand.
And I'm going to jump in here. So guys, Those of you that love to work with business owners, I know a lot of you like to work with business owners. Um, some of you know, I'm not a huge fan of chasing 401ks because I have so many advisors that make about $150,000 that are so big. They're working 60, 70 hours a week running their 401k business, making $150,000 a year, which is ludicrous. And they're too busy to do anything else, even learn anything else, because they're chasing their tail with all this 401k business. So if you want to go after business owners, I recommend two different ways. Either number one, you use the business newsletter drip so that when they retire, that you're there when they sell the business so you can grab those assets to help them out. And this is another reason to work with business owners. But you notice both of them, am I saying, hey, let's work with all the employees? Or are we talking about, hey, let's work with the business owner? What do you think is better, working with just the business owner or working with all the employees hoping that when they retire they're going to move their $70,000 to you or their $100,000 to you? It's so much easier working with the owner. So this is if those of you who love working with business owners, this is the way to work with business owners. Also, who the frig is chasing them in their 401ks? Everybody and their sister is. Let them have the putsy, labor-intensive, low-pay jobs of doing 401ks. You're the only one offering something like this. This is the way to approach a business owner, something they've never heard about before, something that's near and dear to their heart, which is taxes. Business owners are eaten alive by taxes, and business owners are much more likely to do creative tax strategies than a normal guy. A normal guy, a guy who's a teacher, a guy who's an engineer, they don't like tax strategies because they are afraid of doing anything that the IRS might go after them. Business owners, they're way okay with creative tax strategies. So this is where you should be. So go ahead, Jeff. Sorry.
I was going to say, yeah, they tend to be, and you know, the nice thing about this isn't like pushing the envelope in some sort of a gray area with the IRS where, you know, we're taking an aggressive stance either. So
yeah, so business owners don't want to be audited by the IRS. So when they see that it's in the tax code, they don't want a letter, a letter ruling from the IRS. They want to see it is in the tax code, is it black and white, and this is great. But even so, the normal person on the street, they love the idea of reducing taxes, but they'll never pull the trigger. Business owners, once they know it's in black and white in the IRS code, they will pull the trigger on something like this.
Yeah, and they'll get the endorsement of their advisors too, so their CPA will look at it and go, okay, yeah, that makes sense. Their CPA won't have ever heard of this, by the way, so be advised of that. If they do bring this to their CPA, which they inevitably will, they will have not seen this before, but they pretty consistently endorse it once they understand it. So, and we will help you to do that. You know, if the CPA has questions or needs help in understanding it on a case, we'll get on the phone with the agent or with you and the client and the CPA if necessary. So the other thing, this is, like Mike just mentioned, this can be a backdoor to taking over the 401k. So if you get the business owner, the principal, interested in this strategy, guess what has to happen? We take over the entire company's 401k plan because we require a specific plan document through our third-party administrator that requires us to essentially take over that administration so that we can own life insurance inside the plan. This could also then be offered to other, you know, sizable 401ks inside that plan. So if there are other highly compensated employees that might have sizable assets, you could offer it to them as well.
So Jeff, have you ever had somebody go into like a law firm or a dentistry firm or a physician firm, and it goes from one partner to another partner to another partner with this kind of strategy, or is this, I mean, a referral basis? Is there any referrals that are generated from doing this kind of concept?
Yeah. Oh yeah. Yeah. I mean, what's interesting is, you know, when you get a business owner that's saved they've implemented a unique strategy that, you know, nobody's seen before, and they're in a position where they're going to be saving a ton of money on their taxes, that 40% tax savings. They like to brag about that to their friends. So, so they're like, what? Where did you get that thing? You know, so there is interest in, I think you do get some referrals for sure, because once somebody gets this, they tend to think it's kind of a big deal because they got the new unique thing that saves them a ton of money.
Cool.
I have another visual here. This is a little bit more of a simplified version of it where we compare qualified, the qualified distribution at 40% versus distribution solution. Show the taxes here, tax savings. This is probably, some of this stuff, even in the case studies that we do, is probably overkill because it's too many numbers and too much for somebody to look at. Unless you have an analytical engineer type, then they may want to see that. But this is probably much more user-friendly. And business owners are savvy, but the thing is, this is still totally new to them. They have never seen this before. Their CPA has never mentioned it to them before. So in order to help them get their mind around it, I still recommend keeping it simple. And it really doesn't have to be complicated. It may sound complicated, but all we're really doing is buying life insurance, a specific, unique product inside of a qualified plan. In this case, it's usually a solo 401k, although it could be just a regular 401k. But this shows it in a nice, clean, simple way.
Cool. Well, this is awesome, Jeff. So if somebody has a person like in mind for this, they should do what?
I think the first thing to do is just reach out to Jerry and say, hey, I want to put a case together, and we'll get you our case study so you can study that. I actually have a webinar recording that maybe gets into a little bit more detail, though you guys will probably have this recording. If they need to, they can set up a call with me to review the case once we get it back to them. But we have a fact finder, which is just a simple 2-pager, and once we have all the details on that, then we can put the case together.
Perfect. And then one last question. Questions are, do they have to pay tax each year they make that contribution, the first 5 years when they're making that contribution to the life insurance?
No, that's actually happening inside the plan. Yes. So there really is no tax liability. Now, what they will get, just full disclosure, the IRS, in order to make the death benefit tax-free, they do have to pay tax on the pure insurance costs. And so they do have a teeny tiny little amount of tax due every year in order to keep the death benefit tax-free.
Mm-hmm.
It's based on just essentially the internal annually renewable term cost, so it's of the pure insurance. So
cool.
It's minimal. This is something I did want to make a quick point about.
Yeah.
So if he's uninsurable, I did mention this earlier, but you can put this on a family member. We've done this on spouses and kids and not on the primary account holder. So if I'm the business owner and it's my 401k, we can put this on my spouse if I'm not healthy enough to be insured, and even my kids. So we just have to have insurable interest if the kids are active in the business. That might be a scenario where that would work. And let's see, where did I want to go next here? Let me just wrap up with this. Do you have earned income? Obviously, that's the key piece of this. 5 years of earned income. Doesn't have to be the prior or preceding 5 years. It just has to be the 5 years that we're funding the plan. Is minimizing taxation important to them? Especially on money that they've already got a big, tax liability facing them in the near future. Do they have some interest in the tax-free income? Many people will. Are they concerned about RMDs? And like I mentioned, that's a common one. And we can do this on somebody that's even going to have to take an RMD throughout the plan. Like I mentioned, we did one recently that's a gentleman in his early 70s, and he'll be taking RMD during the funding phase of the plan. And of course, are they interested in leveraging those dollars and leaving more behind on a tax-free basis?
But even if you're not insurable, you can go to your kids if they have an insurable interest, right?
Yep.
Perfect.
Yep, which is a pretty unique option. I think most people would think that, oh wow, I can actually use these qualified dollars to buy something on my spouse. A lot of them are buying this because they want to have long-term care benefits or the chronic illness on husband and wife.
Absolutely. That's awesome. Well, thank you very much, Jeff. Again, you're one of the most creative guys I know, especially on the insurance side of the business, so I appreciate you sharing this with us. And guys, I hope you understand that having someone like Jeff on your team, you know, at ECA is such a value-added thing. So thank you very much, Jeff. I appreciate it.
You're very welcome. Hope you guys like it.
I think they do from the comments, so thanks a lot. So guys, again, this is the way, if you want to approach a business owner, approach them with something different. Approach them with something that keeps them up at night. Approach them with something that frustrates them. Don't approach them with what everybody else is approaching with, is hey, what are you doing for your 401k? Hey, I can help you with the 401k. Dudes, this is a fantastic door opener if you like working with business owners. You know, and it's also, when we talk about retiree concerns, it addresses so many of these things that people that are pre-retirees, retirees, all, you know, would you like to have enough money for financial peace of mind? I mean, they want financial peace of mind, which means having all that money in a IRA they're going to be forced to pull out, that causes lack of peace of mind. So this is addressing it. Guaranteed income. I see, go right down the list. It's addressing so many of these things. So I love concepts that address not just one of these, but many of these things. And the concept that Jeff just brought to us absolutely does. So if you got more questions, get a hold of Jerry. And if he can't answer them, he'll get Jeff or some of the other life marketers involved. So this is a kind of concept that I like to bring on an occasional basis, because you might think, I know somebody that I want to approach this with. Approach them. Approach them, okay? And then just a couple more things here. DOL, the PDE 8424 is kicking in here in about 4 or 5 days. So ECA, again, another value-added thing from ECA is they're going to have a webinar tomorrow talking about how that affects us. But talking about the fiduciary trading needed, errors and omission coverage that's needed, the disclosure requirements. You're seeing a lot of insurance companies now coming out with that, their own forms on that, compliance and support and staff resources. So I would highly recommend that you be on that call. If you cannot be, make sure you at least go to the DOL Resource Center and talk to Jeff Van Grinsven, JV, or Jerry at ECA about those things, because it's approaching us here in about 4 or 5 days. Make sense? And then the last couple things, guys, make sure you're using those 5-minute money makers. I'm doing those to help you make more money. We're not asking for a huge investment. So 5 minutes, wow, we love it when passive investing giant Vanguard puts out a white paper demonstrating the need for advisors. So they're talking about why we're needed for advisors. So now, should you whip that out? And let's see some answers for this. Should you whip that out as proof on why a client needs you? No, the articles I give you are not to whip out for a client. It's to give you more confidence in what you're doing, okay? And the next one. And the 5-minute breakdown was, here's a great example of doing a little empowering. Listen to the pride in the woman's voice. You want to know how to do empowering, and you want to know what that does for clients when you are able to do that well? That's a great tape that you should have listened to last week, and will make you want to become an excellent at the skill of empowering. So guys, I appreciate if you when you master the scripts, so that the client assigns motive to their entity or their guy. When you're doing that daily practice of the MIFT, so you are awesome at empowering. So you are awesome at making sure you don't offend them when you have to correct them. When you're great at GOTS and you're doing those 5-minute money makers breakdowns every single week, how many clients should you close? I want to see some answers. How many clients should you be closing? That's right, bud. All of them that you want. That's the way, exactly. So if you're not closing 100% of people, do you have a marketing problem? No. What do you have? Closing problems. So that means you should go back and learn these skills better. Make sense? So thanks everybody for being on the call. I love the concept that Jeff brought to us today, especially if you got that person that you have in mind, or those 4 or 5 people you have in mind. And we will talk to you all next week. Thanks everybody.